Welcome back, guys. Continuing our battle against complex groups. We're into recording number 2, video number 2 on complex groups. And as promised in the previous recording, in the previous video, I now come to the question D. Now D is the examiner's traditional favourite in the area of complex groups. And it's called D because it's a D group, and a D group is called a D group because it looks like this. I'm going to cheat a little bit. I'm going to launch straight into the question. So here we go. Let's pick up the pen here. Question D. So we have question D. We've got entities D, M, I, D, M, I. There we go. The reason that a D group is called a D group is because it looks like a D. Okay, fair enough. Let me just show you that to make it absolutely obvious. There is your D. Okay, so it's called a D group because of that. But how would you know from the question that this is a D group? Well, I don't know. Should we have a look? So, at the year start on the 1st of January, Mersey bought 40% of Irwell, and on the 1st of July, D acquired 75% of M and 25% of I. Stop there. Let's put in those percentages. So, the first purchase is Mersey buying Irwell to the tune of 40%. Mersey buying Irwell to the tune of 40%. And the next purchase is D. D acquiring M to the tune of 75%. But also acquiring a direct ownership of 25% around the outside. Now, these two phrases are not critical to your understanding, but they are useful in the construction of an answer. The two phrases are direct and indirect ownership. Who are we in this story? Well, who are we in every story? Well, the ultimate parent, right? So what is our direct ownership in I? Well, our direct ownership in I is around the outside. It's 25%. So our direct ownership is 25%. Whereas our indirect ownership is via M. Our direct ownership is directly from D to I, but our indirect ownership is through M. Now, you've probably run ahead of me. You've probably got the idea of this already. The indirect ownership is actually less than 40%. 40% is what M owns in I. But if we own 75% of M, then we own 75% of 40% and therefore 30%. If we own 30% plus a direct 25%, then our ownership is 55%. If our ownership is 55%, then our NCI is 45%. Now that's really it. But it's probably the first time that you've dealt with anything quite as complicated as that, so I'm going to write it all down. So here we go. Let me write this fella down. I'll use that red pen I used last time as well. So here we go. Bit of red. Bit of red. Is that working out? Yep. So we have a direct ownership equal to 25%. And that's that one there. Okay? Then we have an indirect ownership. And it's the ownership through M. So it's this 40 here, but it isn't directly that 40. It's indirectly via this 75. So it's 75% of 40, it's 30. And therefore the combined ownership, the total ownership, the ownership is equal to the combined 55% and therefore the NCI is the other 45%. So there we go. So our ownership in the lower entity, in the sub-sub, is 55%, and the NCI is 45%. And our ownership in the mid-sub is 75%, and our NCI is 25%. So there's two NCI, The NCI, bring that down, shall I, for you? The NCI in the mid-sub is 25%, and the NCI in the lower sub is 45%. Okay? Otherwise, it's exactly the same as the previous question. Well, there's another trick, actually. To be quite frank with you, I should address it straight away. At the year start, on the 1st of January, Mersey bought 40% of Irwell, which is useful once we buy our percentage, but prior to that, we're not involved. The thing is, we're not Mersey or Irwell. Do you agree? We're not Mersey. We're not Irwell. We're D. Of course we are. We're D. We are D. And we don't get involved in the group until the 1st of July. And on the 1st of July, we buy 75% of one entity and 25% of the other entity, so we get involved at that point. So the date of acquisition for both entities is the 1st of July. And therefore, it is completely irrelevant what is going on in the group before we get involved. Now, this is important because you can see that we've got a couple of tables to deal with. Goodwill has not been impaired. It is the group's policy to value the non-controlling interest at fair value. But the question is, which fair value? The fair value of the NCI and the reserves were as follows. Well, you've got, two entities, M and I, and you've got two NCI, so you need to pick up two figures for the NCI at acquisition. But the question is, what is the date of acquisition? Is it the 1st of Jan or the 1st of July? Well, hopefully you'll realise it's completely obvious that the date of acquisition is the 1st of July, because that's when D gets involved. We are D, and we get involved in July. So we need to know how big the NCI is when we get involved. So we need the 62 and the 83. And also, the reserves is the same way. We need the 100 and the 150. It doesn't matter how big M and I are on the 1st of January, because we don't buy them on that date. We are D, and we don't buy them on the 1st of Jan. So what's going on the 1st of Jan is irrelevant to us, because that's not the date of acquisition. The date of acquisition of both entities, M and I, from a D perspective, is on the 1st of July. The statements of financial position are as follows. I don't think there's much more to say. Let's do it. So we need net assets of M and I at acquisition and at year end, at acquisition and at year end. Share capital doesn't change. $20 and $10. Reserves obviously does change. They're 172 and 170. 172 and 170 at the now, and at acquisition they were 100 and 150. There's no other complexities in this particular question. There's no fair value adjustments. There's no provision for unrealised profit. There isn't really much going on. So we're done with that. We add down. So 120 and 192, 160 and 180. Lovely. Okay. Into the goodwill schedule. Whoops. I'm going to stick with the old faithful presentation for this. It's a bit of a squeeze for me, but I do like it. Had a moment's pause there to have a think about something, but I think I'm just going to go for it, because I think that's how it would work in the exam. You wouldn't have much opportunity for slowing down and thinking in the exam, would you? I've given myself a bit of a squeeze, but I don't know, I just feel it's okay. I feel it's okay. I hope it's okay. Let's see how it works out. So, the fair value of consideration for the acquisition of the mid subsidiary is all about the 200,000 that you can see on the balance sheet of D. Can you see that 200,000 there? Investment in M, 200,000. Now that represents 75% of the entity. Now the fair value of the NCI is the other 25%, and on this occasion it's not calculated, it's simply given to you. The fair value of the NCI was 62 at that point. And therefore if their bit of the business is worth 62 and our bit of the business at acquisition was worth 200, then the whole business was worth 262 at acquisition. The net assets were only 120, so in fact there's a big whopping goodwill of, is that 142? I better just check it right, with my brain not working too good. Minus 120, 142. So 142 is the goodwill in the mid-entity. Now, the thing is about the one on the right-hand side, which I was just slowing down to think about, I decided just to go for it. The fair value of consideration actually involves two elements, doesn't it? There is the purchase of the 25% directly. There's this 25% directly, that's this 25%. And then there's this indirect element, which is a 40% ownership. And when we consider 75% of it, we get 30%. So there's two elements of the consideration. And I thought about, giving myself plenty of space to consider that, but I decided, in the exam you'll just be whacking it out, and then you'll sort it out as you go. So that's exactly what I'm going to do. I'm going to say the fair value of consideration has got a 25% element, and it's also got a 30% element. And when you add those two together, that 30% plus the 25%, you get 55%. And then the NCI is 45%. So the NCI is 45%. And funny enough, it's probably the NCI that's easiest. So the value of the 45% at acquisition on the 1st of July is given by the question as being 83. Well, that's just a matter of copying without any consideration. Well, it's the same with the 25%. The 25% is the direct ownership. And can you see that the direct ownership, what D paid to buy I, what D paid to buy I, will be in D's books. Can you see the 70? So the 25% cost 70. The question is now, what did the 30% cost? Well, you've got that trick again. Look at that 80. Can you see it there? That 80 in M is in M's books. So M paid 80 for its 40% ownership. But how much did we pay? Well, it's the usual story. Who are we? We are D. And our ownership in M is 75%. So, excuse me, when M spends $1, we spend 75 cents. So when M spends $80,000, when M spends $80,000 on the acquisition of a subsidiary, we spend 75% of that, which is 60. Now, it's a while since I wrote this question, but you can see what I did here. I did this deliberately because it is possible, and more to the point, it's possible in the exam. I kind of made the percentages not really make sense. Can you see what I'm talking about when I say they don't really make sense? Take a look at this 25%. The 25% cost us 70,000, whereas, do you see this? The 30% cost us 60,000. So the bigger percentage cost us less. That doesn't make sense, does it? Well, precisely. Not only is that possible in real life, but more to the point, it's possible in the exam. It's also possible in the exam and it can make it make sense, but don't expect it to make sense. It is possible that the smaller percentage could cost more. And that's what's happened here. So, I mean, cutting a long story short, how much do we own in I? How much do we own in I? Well, we own 55%. And how much did it cost us? Well, it cost us 130. The 25% cost us 70, and the 30% cost us 60. 70 plus 60 gives us 130, so the 55% cost us 130. So 55% is worth 130, 45% is worth 83, so the whole business is worth 213. If the whole business is worth 213, what were the net assets at that point? They were 160. So if the net assets were 160, what was the value of the people at that point? The value of the people was 53, and we call the value of the people goodwill. So the goodwill at acquisition was 142 in one entity and 53 in the other entity. And we're ready to stick that goodwill onto the balance sheet and earn our marks. So group position statement. Or whatever you want to call it. Group statement of financial position. Goodwill. Oops. Goodwill. Two goodwills. 142 plus 53 gives 195 if my calculator's working now. 195. It does look like 195, doesn't it? I wonder if I've got that right. Plus 142. Oh, 195. Goodness me. And then the net assets are 600 plus 112 plus 180. So what's that? I don't feel like working that out with the calculator in my hand. I feel like using that calculator. 892 plus 195 is 1087. And like I say, it's been a while since I've done these questions, so I'm pleased to say I'm not absolutely sure if that's right. In which case I can confirm it by looking at the bottom of the balance sheet. Share capital. So the share capital is the parental share capital of 100. And then you've got the reserves and the NCI. I think I'll stick with the usual technique, which is to do the NCI first. I do confess the NCI is harder in this case than the reserves, but it is usually the other way around. So I'll do the NCI first with that in mind. Well, the first thing about NCI is there are two NCI. There's one in the mid-sub called M and one in the lower sub called I. The ownership percentages are 75% and 55%, and therefore the NCIs are 25% and, I don't know, what am I doing here? 25% and 45%. I'm just writing those down, I guess. But what we need to do is we need to do the roll forward technique. So doing the roll forward technique, what we do is, do you remember how we do this? It's a tricky devil. Basically, you just have the acquisition NCI plus the growth. Do you remember this? So all you do with the roll forward technique is you get the NCI at acquisition and then you roll it forward. And that's essentially it. You get the NCI at acquisition and you accommodate the NCI ownership of any growth of the entity since acquisition. It's quite a simple system. But the problem is that you have this really, really difficulty, which is the mid-sub is complicated by being not only a mid-sub but also a mid-parent, and therefore you have to do this stripping out thing, which last time I did in red, didn't I? So to be consistent, I'll use red again. So we've got minus the sub-sub. So we've got the strip for entity I. So we've got to prevent ourselves from double counting I. So we've got to strip out I from M. So first of all, we have the acquisition NCIs, which are 62 and 83. 62 and 83. But the thing is about this 62 is that 62 is the NCI in M and I, because M includes shares in I. Cool. Now, the cost of the shares in I that are owned by M, well, it's even difficult to say, isn't it? You know what I'm talking about. I'm talking about this 80, aren't I? If you look on the balance sheet, you can quite clearly see that sum of M is I. Sum of M is I. How much of M is I? 80. 80 of M is actually I. There it is, that 80 on the balance sheet. And of that, the NCI ownership percentage is 25%. So, actually, the pure M NCI at acquisition is 62 minus 25% of 80. 25% of 80 is, of course, 20. So 62 includes that 20. And to be pure M, you have to take out the 20, so it's 42. So the actual pure NCI in just M, net assets at acquisition, is 42. And then we roll that forward. So what was the growth? Let's get the two growths together, shall we? Because it's slightly quicker that way. 120 and 92, 160 and 180. 120, 192, 160, 180. What did I say there? I can't even remember. 120, 192. So 192 minus 120. And what was the other one? 160, 180. So 180 minus 160. And the ownership percentage in that one is 25%. And the ownership percentage in the other one is 45%. So at the top, we're starting with pure M NCI at acquisition of 42. And we've got 192 minus 120 is 72, times by 0.25 is 18, plus 42 is 60. So 60, and the other thing is 83. With, what's this figure here? 180 minus 160 is 20. 45% of 20 is 9. So that's 92, isn't it? So 92. So you've got 60 plus 92 is equal to 152. So it's 152, and we'll slap that into position. 152, lovely. And then you've got the reserves. You have to calculate those separately. So let's do that together now. So the reserves are parent M I. Let's pick up these growth figures while I've got them here. 192 minus 120, 180 minus 160. And our parental ownership in that is 75% in the mid-sub and 55% in the lower sub. And the parent profits are 770. So what's 770 plus 72 times by 0.75 is 54. Plus 55 is 11, isn't it? 11 there. So plus 11 plus 770 gives us 835, if my math serves me correctly. 835, if my arithmetic serves me correctly. Well, we'll find out. 835, let's drop that little devil in. 835, keep your fingers crossed, plus 100 plus 152 is 1087. Now there you go. As I said previously in the last video, what's the chances of that happening in the exam? Absolute zero. But more to the point, in the exam, you're not really trying to make the balance sheet balance. And you'll find that in real exam questions, once you start to try them, you'll realise that it's more an element of exam technique than imperfection. The quicker you can blast through these questions, the quicker that you can get into the B section. And the quicker you get into the B section, the greater the quality of your narrative discussion in that B section. And I'll talk more about that as we work our way through the course. But just at the moment now, you want to try and change your philosophy as regards financial reporting, and not so much be trying to get everything right, but trying to get through questions and collect marks as you go. Now, in order to get everything right, you've got to remember the double counting in the NCI. In order to make this balance sheet balance, there is no denying it, you have to pick up this stripping out element here. Now, I suggest to you that that is extremely difficult. Remembering to strip out the sub-sub element of the NCI from the mid-sub at acquisition. Very, very, very tricky. So I'm going to suggest to you that in the exam, there's basically no chance of you remembering that fella up there and not trying too hard to go for it. Now, there's actually two complications that you've done here. One is that bright red one that you see up there, the one that you're going to inevitably tend to focus on. Now, I suggest to you that that one is not important. But the other complication, which you did do and you're starting to get used to, is important, and I think it is worth getting right. And you've started to accommodate it already. It's the dealing with the mid-sub ownership in shares. Now, if you look up there on the board, as you can see, I've highlighted it in yellow. Now, you can see that the 30% ownership cost us 60. You can see that up there. And the reason that we were able to get that figure is because of this that I'm highlighting now in blue. That fella there is worth doing. That idea that every time that the mid-sub spends $1, we spend 75 cents. That idea there will help you to get the goodwill right, and you get the goodwill right, the question's going to flow for you naturally. I'm going to suggest to you that the complication there, highlighted in blue, is worth getting right. That's worth being cool with. The other one about the NCI and the double counting is very, very tricky, and I'd like you to try and relax on that and not worry too much about that bit, because passing a question is not going to be about those super complicated sophistications like that. It's all going to be about bashing out the basics. But I won't be able to prove that to you until I actually show you an exam question. Now, the question that I have that I'm going to record to the next recording, to the next video, is a wonderful question called Rodney. Now, it's based on an old exam question called Rod, and to be honest with you, I've changed it and I've twiddled with it and I've brought it more and more modern to the point that I can't really call it Rod anymore. So I've started calling it Rodney. So the next recording is an old exam question modernised. Now, what I've done is I've made it even harder than it was when it was examined. It was slightly easier than it is now. One of the things I've done to ramp up Rodney is I have included a requirement to do full goodwill. Obviously, all those years ago, they would have been doing partial goodwill, but Rodney is now full goodwill. But it's based upon D. So what I'd like you to do is have another look at D, and then when you feel comfortable with D, just do it one more time, then have a go at Rodney. Rodney, that's the one, that's the exam question. Get yourself good at that question, and it will give you enormous confidence for question 1, the exam question, the group's question, question 1 in the exam. Okay, I'm going to end my recording there, and I'm going to invite you to have a look at Rodney when you feel comfortable with D.